made me disconnect my coax cable when I unplugged the machine and the coax cables. Never had to do that one before. Anyways, good morning, everybody. 8:22. It is Jackson Hole this week. It's going to be the main focus for most of the week. Everybody's going to be looking at that. We're still parsing every little bit of data. The Fed had not really given a signal that they were going to pivot in early 2023, but that's what the market had really been pricing in these last few weeks. And we've had short coverings, short squeezes. We had these drastic moves in the FX market, a lot of things going on the energy side of things. Then there was, um, some performance chasing by the institutions, and those VC funds had to buy in when volatility got low. So there was a lot of reasons for that rally that we just had that lasted, a good 6 weeks or so. Now the Fed, seeing how things just were rallying higher and higher, they wanted to go back out and reiterate that they're not going to pivot anytime soon and that they're not going to blink. They're not going to stop raising rates. They're not interested in any kind of pause until they have definitive trending proof that inflation is abating. And I think we're going to hear more about that at Jackson Hole this week. And the market is kind of rocking it out a little bit due to that. But keep in mind, we did have a really amazing rally, and most of the market got into that 200 period moving average. It was time for a pause, right? So just kind of keep that in mind. Whatever narrative they're throwing out there, at the end of the day, the market needed to take a break and pull back. So they can give the whys and the excuses all they want, but technical analysis told us to expect a pullback at some point, and we finally got one. So right now we're looking at finance juice. This is kind of my go-to in the mornings. I want to look to see what economic events are on the schedule for the day, if there's anybody scheduled to talk. I also like it because it's got this market wrap. And it does this for 3 markets, for our market, the Asian market, and then the European market. I start out here looking to see if there's anything going on globally that I might want to keep my eye on, right? Things that may not seem real bad at first, but then end up getting really out of control. The example that I like to use is when that ship got stuck in the canal, right? That became a really big deal. So, as you can imagine, most days when we come looking for that, we're not going to find something like that, right? Most of the time. So, we just look, make sure there's nothing extreme, get our list of what's on the docket for the day, and we move on. We are getting more data today on inflation. We have the Chicago Fed National Activity Index at 8:30, and then we have additional auctions at 11:30, and that's it. That's a wrap. So that leaves us open for an afternoon 0-day trade. We had a really nice trade last night. I don't know if any of you trade in the evenings or in the mornings, but we opened gapped down about an 0.18%. And the market dropped down, kind of built a little bit of a base, had a TRB, broke over with a Busby, ran right back up and stopped right where we opened. What a play. That trade right there, you get a couple opportunities for that, right? Because when we open at 9:30, you're going to get, not every day, but it has the potential to make that same kind of move. These are what I call institutional pivot points or universal pivot points: open, high, low, close. I know they seem very, very simple, but they are very effective, and they're on any machine that you use, right? Any broker, because it's just you drawing with your line. So you don't need a special indicator. You don't have to you know, buy for some expensive program. You don't need advanced education on how to use it. Open, high, low, close. That can be for the day, for the Globex, for the week, for the month, for the quarter. So we are inside day breakout. In fact, we gapped down outside of yesterday's price action. And that bounce that we had last night that I was just pointing out was also the low of Friday. So it wasn't just where we opened, it was Friday's low. That's a twofer, right? When you can stack them on top of each other, they're more powerful. So the idea right now is, are we going to maintain this breakout or are we going to get back inside the box? The volume's not extreme, but it's a little heavy this morning. Not out of line, and that's really just what we're looking for, right? Are we within the guidelines or the boundaries of a normal morning? Yeah, nothing really bad standing out yet. If we were to make a move to the upside to try to get back inside of the Friday's range, we'd have to get through a retracement level, the 236, and that is at the cog line 4211. We're underneath the daily pivot. We are underneath the weekly pivot. We're starting the week off not just bearish because we have some down candles and we're down a little bit, but bearish because we're underneath the weekly pivot point. The base case argument is that we hold these lows without really expanding farther to the downside. Now, what I like to do is start out here on the daily chart, and that cyan line, that is an anchored VWAP. It's anchored to the first of the year, and think of it like the yearly average price, right? For a generic phrase for a moment. What's the yearly average price on the ES? And it would be that cyan line. And then are we above it or below it? Because when you think about purchasing power, do you want to buy something when it's higher than its average price, or do you want to buy something when it's lower than its average price, right? Same thing on the sell side. You want to sell it when it's above average, or you want to sell it when it's below average. We did manage to get above that line. We weren't able to stick it. We couldn't keep it. Came back inside of it. The weekly expected move is another thing worth looking at while we're out here on the daily. We want to take a look at the size of last week's box and then compare that to the size of this week's box. We're really just asking, is the implied volatility expected move within the options chain showing a greater anticipated move on the week this week than what we had last week? And if it's bigger or smaller, then, by how much? And are the markets really starting to see something extreme on the horizon? And it doesn't appear so. That range wasn't much different from last week to this week. The white line that's running across my screen from upper left to lower right is a linear regression line, and it looks at how many candles you have. So if I was to put this on your chart, the line would look different. I'm on a year-to-date chart. We had these really nice swing highs and swing lows all through 2022 until we built that base. Now we're coming out of that base and we're starting to kind of trend in the other direction. It takes a long time for that line to get caught up. But there is a drawing tool that is the same thing. It's a regression line. And you just tell it where you want to start. Well, I want that mid-June low. So I'm going to start there and just drag my mouse to the right. And now we get a whole new linear regression line. And it's going to depict our swing highs and our swing lows. Generally speaking, you're going to get equal swings. So if you get like a 2% move on the upside, you're likely to get a 2% move on the downside. Another thing worth noting is when it doesn't complete the swing, right? So like you get your arch up and then your arch down, and you're expecting a new arch up and it gets stuck, pulls back down, that resets the swing. And now this becomes the measurement. We'll call that a 1.5% move. We would then expect a 1.5% move on the other side, right? And anytime it gets stuck or shunted, that it fails to complete the swing, it's usually an indication that there's a sentiment change. I like using these linear lines mainly because when we're already at the highs and I'm trying to figure out what the market's going to do, you got to kind of ask, the what's more likely question. When we've already completed a swing and we're on the edges of that swing, is it more likely that we're going to continue to move in that same direction? Or is it more likely that we're going to pull back the other way to maintain its linearity? Yeah, it's a bad word to try to use, but it fits, right? So now that we're, trying to parse out what's going on here, we're at a very critical level. And if the bulls don't defend this level today, heads up, baby, because we're going to be going down with like a brick in water, right? This has to be defended today. And there's really no other way to approach it. It has to have the bulls step in today. It's really, really critical. If we use what they call a swing over, I drew both. We can start with one and then the other. So that moving ever that trend line right there is just putting your line at your starting point, dragging your hand across, and then swinging up and stopping at the first pivot that you hit. And that was the first pivot that I hit, August 10. And we can see the market broke down through that. Right now, if you wanted to do the trend line the other way, pick your starting point and then take it to the first pivot that you come into. That one we'd already broke, right? And that one was negated. We would take it off after it was broke. If I was to go over to Trend Spider, it would show both, right? That's the way the platform does it. It just throws every single trend line at you because there's many ways to do a technical analysis, right? I often refer to the regular technical analysis and then the OCR analysis, which is a single candle analysis. Those are two that I use most often, just your basic regular technical analysis and OCR. Right. So right now we're going to be focused a lot on this double bottom. We're going to be really wanting to see this market stabilize and present clear, valid signals. After the move that we've had and all this chop that we've been sitting here in this 15-point range, we could just stay right there. Right. This market doesn't owe us a rerun back up to where we started last night. And it doesn't necessarily need to get worse and go down. We could just hold the line. And if we're in one of those really tight ranges today, it's very likely going to be choppy and difficult to trade. Right. So what I would recommend is look for very solid, very clear signals that we're going to break this zone here, this 15-point zone, and start expanding back up. If we do get above that 4190, then we're very likely going to re-challenge the open from last night. There is some pivot points in the way, right? The 4200 is a pivot because it's a round number. The cog line at 4211. So, there are things where we're going to bump our head and struggle a little bit, but that would be the base case argument is that if we can break this red line that I'm showing here, which is the ADR half, we're very likely going to get back to the open. Now, where we go from there, you know, um, due to this liquidation break that we had at 3 o'clock in the morning, we could just get back up there to like resolve this liquidation break and then turn bearish again. So don't think just because we get back up to that open that we're suddenly bullish. If we were to continue lower, let's start with the failed flag setup and just measure that for the downward break. So you're looking at a warning line at 41.70 and a half, and then the target would be 41.65. Just round up, right? 41.65 would be our target for a new downside break. So if we get that double bottom and we actually continue to expand, that would be my first target, 41.64. I just say 41.65, right? There's no reason to haggle over a couple ticks. Now, from there, we would anticipate a bit of pullback, some consolidation. Then we would move into our new target level. The warning center puts us at the yellow line. That's our full ADR level. That's a 1.5% move on the day. If we get through the warning center, then our next target would be 41.51. And that would have us outside of our ADR. And we would just start considering that we're in an extreme move. It would have to move that far before we would even um, entertain the notion that that's an extreme move. All right, so 41.50 is not out of line. It's well within our reach, and it's just skirting the logic that we might consider that a little bit extreme. If that failed flag, because right now it's not failed, right now it's just a flag. If we do get that failed flag, then what we want to focus on is a reciprocation play, a move back up, right? So I'm put my fib back in there. And that gives us our 786-100 base or our channel down here. And you can see the market's already tried to break out of that a few times. We want to see a clear, definitive break of that zone, preferably get through that ADR half. You could just target VWAP. VWAP is managing, well, the midnight VWAP that I use is managing to relatively keep up with the market. You could use a trending moving average. Generally speaking, when we're in a strong downtrend, I like to set my moving averages to high. So if you're using like a ride the nine or a 10-20 cross or something like that, instead of using the close, if we're in a bearish move on the day, I'll use the high. The logic behind this is I want to know where the average high is in a bearish move. Because if the market jumps higher than that average high, I've got to take into consideration that maybe we're not in a bearish market anymore, that we may be seeing a sea change in the market that day. I would no longer be interested in what the average closing price is. I want to know what the average high price is. That way, if we break it, it gets my attention. Same thing if we were bullish on the day, I would set this to the average low, right? Just one little tip. If you get to playing around with the price measure that you use, the close, the high, the low, change your moving average to remind you that you've changed this indicator. Otherwise, you may forget that that's not a regular moving average and end up reading it differently, right? I do use the close, a normal moving average. I use those all the time. So I don't want to get these two confused. If you make an adjustment, do something that reminds you, oh, hey, yeah, that's not my regular moving average. I changed it. To me, I just changed the line type. And really, I don't even need it on there anymore. Seeing how it reacted down here at these lows, it's already caught up and we've already crisscrossed through it and it's flat now. So I don't need it after all. All right, we're looking at a 10-day, 30-minute volume profile. Generally speaking, when we're at the top of the box, we expect to go to the bottom of the box. When we're at the bottom, we expect to go to the top. When we're outside of the box, we expect to get back into the box. You can see the shallow area from the close of Friday to our current location. There was a little bit of volume support, and that volume support did its job. It held the market a little bit in that initial move last night, but it wasn't enough. We managed to fail through that, and we're in this shallow zone. Price tends to move through those shallow zones really fast because it's not getting any help or support. 4111 is basically the line in the sand. I mean, it's cutting it close on, whatever we're going to get out of the market. Now, notice the TPO time price opportunity profile on the right side. It's the one in blue. This is volume by time rather than volume by price, which volume by price is on the left. Right? So by time, we've spent a considerable amount of time at the same spot where we spent most of the volume. That makes sense, right? These two point of controls are lined up really nice. The value area low, however, is much higher, and normally we're not that far off, right? The yellow line at 43.13 and the yellow line at 41.94, those are the value area high and low. In between those two yellow lines represents one standard deviation of all of the volume, basically 70%. Now, since this is the time side, that means 70% of all of the time spent in the last 10 days was between these two levels. Well, that's not a massive amount of surprise, right? Like, thanks, Captain Obvious. Kind of got that figured out. Because that's where we've been spending last week, right? It's above that level. Well, we're below it now, and we're in this shallow zone. And we really don't have a lot left to help us out until we get to that value area low at 41.13. So it really needs to kick in and do its job when we get down there. Normally, we would keep this at a 5-day, 5-minute, but I'm going to zoom out a little bit. We're going to add some more profiles. And what we're looking for are untouched points of control. We call them virgin points of control, VPOCs. Now, this one's no longer a VPOC because we hit it, but we're going to go back and examine that. And we'll just carry the line, see what else we get. All right, so it looks like we got one here. We'll have to scroll back to see if we hit that one. And that's 40.73. Then we have one at 39.73. And the idea is you would want to leave these on your chart, right? You don't want to take them off until they get resolved. And that means you might have a line down there for years until it finally gets resolved. There would be more back here. But we'd be so low down at that point that kind of get into um, an unlikely scenario that we would fall that far today. So 4106 is a untouched point of control that needs to be resolved. This is the joy of keeping everything from previous price action, right? We did a lot of work in that zone, and when I turn it on, we can see that all of that work is still there. Got retrace levels, warning centers, Globex highs and lows, and there should be some untouched point of controls still in there. Yeah, there's the VPOC from 4073. And then another one at 3927. We're not going there today, right? But that's the idea. Keep those lines, keep your levels. It'll save you a lot of work. All right, so there is some talk about a hurricane hitting the Gulf. If that happens and they shut down, it's going to really affect us. Our strategic levels are depleted drastically, right? So there's not a lot sitting in the kitty. Um, Energy prices could get a significant boost if we happen to shut down the Gulf, right? And worse, if there's some damage done out there that makes that shutdown last longer. Now, I worked in the oil and gas industry for 20 years. I've been in the Gulf of Mexico during hurricane season. And generally speaking, they just put in a temporary plug and they lock everything down and then get stateside and wait for the worst of it to pass and they go back out. It's not usually a big deal unless structures get damaged. So a 2 day, maybe a 3 day pause at the worst, and then they're back up again. Some of the moves that we've seen across the world has been due to energy. There was some talks this morning about the nuclear agreement over in the sand countries. So that's worth keeping an eye on. If they get a new nuclear agreement and allow those nations to bring production online and sell barrels across the US or across the world, that's going to bring those energy costs down. It all belongs to the inflation narrative, right? When there's not a lot of energy, gas, oil, then costs go up. If oil and gas costs go up, so does manufacturing, shipping, everything else. Right? And it all runs right back to what the Fed's trying to do, get inflation down. So on one side, with the Gulf of Mexico possibly getting shut down to a hurricane, that's going to take prices up. It's going to mess with inflation data. But on the other side, if we get that nuclear agreement and we can get another nation putting barrels out on a global stage, that can help get the inflation down more. So definitely worth keeping an eye on those two situations right now for a better idea of what the market perceives the Fed is going to do in September. You can see here with oil, the CL crude, we've been kind of maintaining since Thursday. We peaked outside the box, but we never really went anywhere. Got a lot of indecision, a whole lot of market on wait. The VIX is continuing to expand to the upside. It has finally woke up. Really want to keep your eye on that for backwardation, right? If we slip out of contango, you definitely want to know about it. We had that significant move in the bonds Friday, which was interesting because we had stocks and bonds both falling Friday. Bitcoin, gold, everything was going down Friday except the dollar and the VIX. and oil just kind of hung out. So these are the tools you want to continue to focus on, right? See if that dollar calms down. We want and need that dollar back around the 105 area. So seeing it trend back in that direction would be a really good for the market. Let's take a quick look at volatility. Then we'll jump into some stock talk. So we're looking at the VIX futures here. The active contract, the newest one, 30 days out, is at 25.20. That's September, the active contract. So we want to look at October. It's higher, 26. Then we get to November, 27. December, 27. January, 28. So the curve is like that. That's contango. That's good. That's normal. That's what we would want to see, right? Things that are close in time are cheaper than things that are farther out in time. If we had looked and the prices were the other way around, that September was high and December was low, then we would have been in backwardation. That messes with skew models. It messes with your options pricing. It gets all kinds of chaos, right? It's all kinds of bad stuff. Now, I mentioned about a week and a half ago that the VIX was sitting at really low levels. And that it would have been a good time to buy some volatility just because it was cheap, right? We've been in the kind of market where we get a lot of chaos. We continue to hold these high levels of volatility. So when it's on the low end of that, just buy some up. Now, this is a trade that most of the time would lose, right? Unless you're specifically trading an action like a breakover, uh, an IX10, a red to green, unless you're trading some signal, just randomly going out and buying volatility is a trade that would normally have a low expectation of profit. And that's not a bad thing, right? This is like insurance. When you put insurance on your car, you really hope you never get your money back, right? Because you don't want your car to get destroyed. And that'd be the only way you get your money back. Well, when you buy volatility, you kind of really don't want that volatility to pay you because that would mean that the rest of the market went into the toilet and volatility spiked. And now, sure, you're getting paid for that volatility, but your 401k and your retirement account and everything else is getting whacked. So we buy it when it's cheap. And if nothing happens, if it doesn't spike, that cheap volatility, well, it was cheap. We shrug and call it the cost of doing business. A lot of markets hit that 200 period last week and took the rejection. So we're going to be focused on the monsters of tech and finance. Those two are the risk on sectors to begin with, tech and finance. And earlier this morning, the S&P and the NASDAQ were wider apart than they are right now. The S is down 1.25. The NASDAQ is down 1.5. So they're not that far out of line, both tech and finance. But we want to see what's the financials doing, right? If we can get some assistance from them, we can slow down or shunt how far we fade off due to this tech punch. All right, so the sectors this morning that are doing even reasonably well, my benchmark is 0.5%. We got IYE, energy, XOP, energy, gas, again, energy. Other than that, we're kind of flat. When we get into the negative side, my benchmark is again a half of a percent. But once we get through that level, it's utilities, staples, emerging markets. We use that for a global risk on, risk off gauge. Financials, just everything, right? Gold, um, even our defensive names this morning are down. Industrials and building materials, those are, defensive sectors. Just like Friday, when everything went down, that's really what we're looking at this morning. Everything but energy is down. The argument or the perception is, well, by how much? Who's down the worst? And the worst is cloud computing, semiconductors, and then just broad-based technology, consumer discretionary behind that. So the financials are not as bad as tech. So all of those sectors are the old school legacy sectors of the S&P. I like to kind of step inside that and look at a more modern sector, right? Things like crypto. Well, crypto's not looking too hot this morning. A few names, right? A little bit, but not much. I would say mostly negative. The electric vehicles market, kind of like looking at that as its own sector. Li Auto is up this morning and XPEV. Ride is pretty close. If it can get past that point 0.5 level, then I would consider that up as well. What I'm not seeing, Ford, Tesla, NIO, right? Those GM, those names aren't up this morning. And speaking of autos, Dodge is getting rid of the Charger and the Challenger. They're phasing out both of those two cars to put their hat in the ring in the electric vehicle market. So I found that to be significant. I don't know what I'm going to do with it yet in the longer term, but Dodge is coming into the game. It'd be interesting, right? See where it goes. Now, I know that some people who don't trade options are just basically stuck going long in the market unless you're running an inverse ETF. So we really do want to ask the question, well, what is long that I could go, what's green that I could go long in today? There's always something, right? These two watch lists down at the bottom are my options watch list. They have to have weekly options and they can be in the list. That's a very low benchmark. InBev, MKND. So let's come back up to these sectors then. We stopped at EV, but we got pot stocks. We can lump them into their own grouping, right? And they very often do their own jam. They don't necessarily move with what the S&P and the NASDAQ is doing. And that's where you're really going to want, if we do start to see that capital rotation, think outside the box. 80 to 90 names are all out of 100 are all going to do what the S&P is doing. Commodities, pot, precious metals, energy, oil, those sectors are very likely not going to do what the S&P is doing. Right? So if you're looking for some diversification, it's not always some long names and some short names. Diversification can also be an uncorrelated market state so that everything you have isn't moving like SPY. To me, the play today is energy. Energy and finance are two really great day trade sectors. They have very liquid names that are not overly expensive. And I've been doing a lot of those names throughout 2022. Right? That's been my go-to a lot of days. Energy and finance. I will not be streaming in the morning. I will be streaming this afternoon. That's going to be the new schedule is afternoon streams. I think you guys will like it because in the afternoons is where I generally put my swing trades on, right? And I'm going to put those trades on whether I'm streaming or not. So I like the idea that I can stream showing you guys live what I'm looking at, what names I'm getting into, what my thoughts are about where I'm getting out. And of course, it's not paper, right? It's my accounts, it's real money. In the mornings when I stream, I rarely ever take a trade. So afternoon streams, most likely Monday through Thursdays. Um, it's on me, when any of those streams will be futures related or not. And I'm sure there'll be days where we will do those. Otherwise, guys, I will see you this afternoon. I'll put into the chat what time this afternoon because I'm not quite sure what time. And otherwise, I'll see y'all tomorrow.